Create videos with AI actors. Greetings to all investment enthusiasts. Welcome to this presentation, which will introduce you to the fundamental principles of stocks in the stock market. Whether you are a beginner investor, a curious amateur, or a passionate individual looking to deepen your knowledge, this presentation is designed to make key financial market concepts accessible and understandable. Today, we will delve into the basics of stock investing. What is a stock? What are the different types of stocks? How does the stock market work? Why and how do stock prices fluctuate? How do you buy a stock and read stock price charts? We will also cover key concepts like bulls and bears, as well as some peculiarities of the stock market. By the end of this presentation, you will have a better understanding of the financial markets, and you will be more prepared to navigate this vast field. The world of the stock market can seem intimidating at first glance, but it is actually a structured and organized marketplace where companies, governments, and investors come together to buy and sell financial assets. These assets include stocks, bonds, and other types of securities. The stock market has existed for centuries. The first modern stock exchanges appeared in Europe at the beginning of the 17th century. In 1602, the Dutch East India Company issued the first stock on the Amsterdam Stock Exchange, marking the beginning of what we know today as the stock market. Since then, financial markets have multiplied around the world, from New York to Tokyo and from London to Paris, with increasingly sophisticated platforms and millions of transactions taking place every day. To understand the stock market, it is essential to understand what a stock is. A stock is an ownership security that represents a fraction of a company's capital. When you buy a stock, you become a shareholder of the company, which means you own a portion of it. This grants you certain rights, including the right to vote at general meetings. Shareholders can weigh in on important decisions, such as the election of board members or mergers and acquisitions. The right to dividends. Dividends are portions of the company's profits that are distributed to shareholders, usually in the form of cash payments. However, not all companies pay dividends, as some may prefer to reinvest their profits into the company's growth. The right to a share of the assets. In the event of the company's liquidation, shareholders are entitled to a portion of the remaining assets after creditors have been paid. Stocks are generally listed on a stock exchange, which makes them easy to trade. There are mainly two major types of stocks. There are common stocks, which are the most common. They give shareholders voting rights proportional to the number of shares held and allow them to receive dividends if the company distributes them. These stocks are the most sensitive to market fluctuations, as their value depends directly on the company's performance. There are preferred stocks, which function differently. Holders of preferred stocks do not have voting rights, but in return, they often receive fixed and prioritized dividends, meaning they are paid before common shareholders. In the event of liquidation, preferred shareholders are also repaid before common shareholders. Some investors seek high dividend-yielding stocks, while others prefer to invest in companies with high growth potential, often with low or no dividends, but with higher prospects for appreciation. The stock market operates like any other market. It is a place where buyers and sellers meet to trade. What is unique about the stock market is that the assets being traded are financial securities, particularly stocks. The process begins with an initial public offering, IPO, when companies decide to open their capital to the public for the first time. A company offers a certain number of shares at an initial price. Once listed, these shares can be bought and sold on the stock exchanges. Transactions are facilitated by brokerage platforms and occur during market hours. Stock prices fluctuate based on the law of supply and demand. If more people want to buy a stock than sell it, the stock price increases. Conversely, if more people want to sell than buy, the price decreases.
Stock price fluctuate for various reasons, often depending on information available about the company, the market, or the broader economy. Here are the main factors that influence stock price.
Company financial performance. A company's profits, losses, and other financial indicators, such as revenue, profit margins, and debt, have a direct impact on its stock. If a company reports better than expected results, its stock tends to rise, while disappointing results may lead to a decline. General economic conditions. The health of the economy also plays a crucial role. Indicators such as unemployment rates, GDP growth, or inflation affect investor sentiment. For example, a recession can lead to a broad decline in stock markets, while a period of economic growth supports rising stock prices. Interest rates. When interest rates are low, stocks become more attractive because alternatives like bonds offer lower returns. Conversely, when interest rates rise, stocks may be seen as riskier compared to bonds, which become more profitable. Political and geopolitical events, political crises, international conflicts, and unexpected events such as natural disasters or pandemics can also affect stock markets. For instance, geopolitical tensions in a key energy-producing region can drive up oil prices, which in turn impacts companies related to the sector. Market emotions. Finally, it is important to understand that financial markets are influenced by investor emotions. Dramatic rises and falls can sometimes result from irrational fear or enthusiasm rather than solid fundamentals. Knowing how to read a stock table is essential for any investor. Here are some key elements you will typically find in a stock table. Stock symbol. This is a unique identifier for each company, for example, MSFT for Microsoft. Current price. This is the price at which the stock is being traded at a given moment. Change. This shows the difference between the current price and the previous day's closing price, often expressed as a percentage. Volume. The total number of shares traded during a given period, usually the day. High/low. These indicators show the highest and lowest prices the stock reached during the day or over a specific period. These pieces of information help you understand the state of a stock over a given period and identify market trends. In stock market jargon, you will often hear the terms bulls and bears to describe different types of investors. Bulls are optimistic about the market's future. They believe that stock prices will rise and aim to buy stocks to sell them later at a higher price. Bears, on the other hand, anticipate a decline in stock prices. They may sell stocks they don't yet own, hoping to buy them back later at a lower price, a strategy known as short selling. In addition to these terms, you might also hear about stock market crashes, sudden sharp drops in prices, or speculative bubbles when asset prices rise unreasonably only to collapse afterward. This has been a comprehensive introduction to the world of stocks and financial markets. Investing in the stock market can be exciting, but it requires a solid understanding of market mechanisms, strong investment strategies, and careful risk management. If you enjoyed this presentation and would like to learn more about topics such as the history of the stock market, technical analysis, or how to build a diversified portfolio, don't forget to subscribe and turn on notifications to be informed about our upcoming videos. A big thank you to everyone for your attention, and see you soon for more financial adventures.